When it comes to financial education, you have to take it among yourself to really educate yourself. And in today's video, we are doing a compilation of all of the videos from this entire week. So I hope you enjoy it. Are you finally tired of your credit card debt? Credit card debt can be very easy to get into, but extremely difficult to get out of when you start accumulating a higher balance in credit card debt through overspending. When you think of clothing, electronics, food, takeout, regardless of what you're doing with that credit card debt, you got in this situation and it's time to get you out of it. When you think about the payments that you're making on the cards, majority of people are making minimum payments, meaning the interest rates are running much faster than we want them to, usually 20, 25, 30%. To get out of debt can be not only incredibly difficult, but it can also be very, very expensive. But let's say you find yourself with a large sum, $10,000, $20,000 in credit card debt. We're going to look at some methods in today's video to help you get out of it and really get back on track managing that debt. Now, first one we look at is debt relief companies. Now, debt relief companies have a couple of abilities that they can do debt management card programs. They can consolidate your debt into one payment. They can make the payments directly for you. They are working on your benefit as your advocate, as your credit counselor, that you can go ahead and work with the creditors themselves, and you don't have to do it yourself. They will do it for you. Couple things to note that are really important here is number one, they do charge a fee. They are for-profit companies, meaning that a portion that you're paying to these debt management programs are probably taking a chunk of that. And of course, for this, you can do it by yourself. If you're willing to sit down, make the phone calls, make the negotiations, you can make it happen yourself with your local credit union, but you can also manage debt and have these calls on your own for free if you're wanting to work with the creditors. Now, of course, you could also look at debt settlement. This is where it comes to more of an extreme situation where is the debtor or is the individual that is lending you the money through the credit card going to get any money at all, or could it be a bankruptcy situation? Could it be something where they're going to forgive a portion of a debt? I have seen this, an example of this. We had an individual that had around $50,000 in credit card debt. They were looking at bankruptcy. They were looking at a couple different options. When you start getting to 50K, the meter on that is running at about $800 a month they were paying on a minimum payment, which is kind of crazy. So we knew debt settlement would be the option. We talked to Bank of America. That is right, it was through BOA. Bank of America settled the credit card debt, all said and done, closed, 22K out the door instead of the 50K that they owned or that they owed. Kind of crazy to think, but yes, they did settle the debt. Now, when we look at number two, using a debt consolidation loan. Now, with this debt consolidation loans, you're borrowing money from a financial institution, whether it's a bank or a credit union. Credit unions do usually have much lower rates. And I know a lot of traditional banks don't do the consolidation or don't do the unsecured or personal lending. This could put everything into one monthly payment. And with that one monthly payment, most of the time you are saving a lot on the APY of the credit cards, and you're saving money kind of on both sides, where if you consolidate it, let's say 5 cards into one payment, that one payment a lot of times is at or about where your credit card minimums are, making it easier because now you're paying a lot less interest. And of course, this is very, very important when it comes to the consolidation loan, is you cannot continue to use those cards. This is where people really truly get in trouble, where let's say you have that $20,000 in credit card debt, you consolidate it to a consolidation loan. 3 to 5 years down the road, you still have that loan because you took it out for 60 months and the loan is almost paid off. And guess what? You have another $20,000, $30,000, $40,000 in credit card debt because you have never adjusted the budget, you've never changed up the spending plan, and now you're in the exact same spot that you were years ago. And I have seen people that have continued this cycle year over year and decade after decade, continuing to go ahead and carry debt because they are not budgeting properly and they are not living within their means. Looking at number three, using a payment strategy. This, of course, is my absolute favorite. When you have the ability, we have two big payment strategies. Number one is the debt snowball. Now, Dave Ramsey baby steps. Debt snowball goes from your absolute lowest balance to your highest balance. Every single extra dollar goes to that lowest balance, so you knock it out as soon as possible. Now, this way psychologically works the best because you can see the elimination of debt, where again, if you have those same 5 credit cards, as soon as you knock out one, you know it's gone. Now you only have 4 left. Simple math, counting it down. Now, of course, the way that I prefer and the way that I really teach is the debt avalanche approach. Now, this, instead of going by balances, this goes from the highest interest rate to the lowest interest rate, regardless of the balances that are on there. Now, in the debt avalanche method, when you're making payments, you are getting the most bang for your buck, because every dollar that you're putting in excess of that payment is going towards the card with the highest interest rate. Now, in both of these methodologies and both of these payment strategies, you are paying the minimum balance on every single card except the one that you're focusing on and except the one that you're putting all of your money. So this, of course, is going to eliminate the debt much faster. And again, with the two methods, I don't really, I do prefer the avalanche method, but any methodology and any thought that you're doing to eliminate the credit card debt, kudos to you. Good job, big thumbs up, pat yourself on the back. You know, debit or credit cards are an issue, and it's at the point where you do want to eliminate it. So looking at number 4, it is taking on a side hustle. Not only can you eliminate debt, there's a bunch of different ways to structure it, a bunch of different ways to repayment it, going through, again, the avalanche and going through that snowball method. But looking at a side hustle, you could do this in addition to the full-time job, or even leveraging your full-time job to pick up maybe some extra hours, even if this is kind of short-term, to generate some extra income. Because when you think big picture, you only have really 3 buckets for your finances. First one is your income. How much money are you generating? So either that bucket is going to stay the same, or that bucket is going to get much larger with the extra hours, with the overtime, with the side hustle, with the side gig, whatever it may be. Second bucket you have is that debt bucket or that liability bucket, where if you can shrink that by paying off the debt, it is going to make a big difference. And of course, the third bucket is, what do you have left? Are you running every single month in the red? Are you negative when it comes to cash flow? Are you having to rely on credit cards just to support the lifestyle you had? Might be a good time to take a good hard look at your spending plan. Where can you cut? Could it be a mortgage? Could it be a car, auto loan, looking at a refinance, looking at a payment, getting the cash flow under control, looking at insurance, really taking a hard look on everything financially, seeing where you can cut and making a big difference. And of course, big scale, taking out a home equity. You can borrow against equity, which I do not recommend to anyone. But if you are looking at either taking a home equity or doing really that debt you're carrying, this can be huge when it comes to larger balances. I have seen everyone, when it comes to credit cards itself, that has run from, 5, 10, 15,000, all the way up to almost 200,000 in credit card debt, which of course, when you start scaling and when you get to those larger numbers, home equity loans make a big difference. Now you have to take that really into consideration and think, because when it comes to the home equity, you are putting your home up as the collateral for the loan, meaning by chance, if for some reason you're unable to make your payment, they are taking the home. It is not just debt collection agencies calling you. It is not just credit cards that are frozen or the limits are expired that you're dealing with. You're looking at a fact that they will take your home. And essentially, regardless of where your equity position is, let's say you have a $500,000 home, you borrowed $50,000 in home equity, you're not paying any of it back. They are going to start the foreclosure process, even if you have another $450,000 in equity in there, which of course, again, that's going to be really profitable for the bank or credit union if they're getting that for a steal. And the final one we think about here is the budget cuts. That is the way, when you're looking to consolidate debt, when you're looking to pay off debt, spending less money will give you more money to pay off in that third bucket. This is where, again, even if it is temporarily, this is where the beans and rice is coming in. This is where the sacrifices are coming in. Cutting entertainment, cutting away meals at restaurants, cutting away your daily coffee, cutting away a lot of things. And I know some of these might be little things, but you know what? If I can cut and save $30, $40 a month, let's say that I spend for a couple trips to a coffee shop, or $100, skipping a meal out to eat, where I could supplement it by $20, $30. Anytime I can put $50, $100, $150 on a monthly basis more onto my credit card, again, it might be short term. There might be a point where you can get that. So when it comes to the bottom line, getting out of debt, $10,000, $20,000, $30,000, when you start looking out of there, it's not easy to do, but you can absolutely do it with a little bit of discipline. Looking at a couple of the strategies that we have right here. If you have credit card debt, how are you looking at it and how are you really approaching it? It's funny because one of the things that I do is, when I do consolidation loans, when I do home equity loans for debt consolidation, I have the candid conversation with people. How are you going to repay this? What is the plan to repay this? If you're taking out a home equity that is running 15 years, are you going to keep this home equity and this debt sitting around for the next 15 years when you've already had it for the first 5 to 10? You're looking at 20, 25 years right there that you're carrying and trying to pay for the exact same debt, which to me is absolutely crazy, because that could be 25 years with that interest you're paying that could be invested into the market or really taking dream vacations. Regardless, there are so many other things you can do with your life when you do not have debt within there. All right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching. Do you want to improve your finances? That is the focus why we built this educational channel, to give you financial well-being as well as a lot of literacy. Now, when it comes to financial well-being, this means having the ability to manage your income, manage your investments, manage your spending, also budgeting property. And in today's video, we're going to be looking at 7 signs that show that you're financially healthy. So let's go ahead and get into this. With the first one, you don't try to signal your wealth. Now, of course, this is lifestyle creep. This is keeping up with the Joneses. We have seen this so many different times. It is utilizing big ticket items to flaunt exactly how much money you have when it is a zero-sum game. When you think of someone who buys a Lamborghini, that's buying a Ferrari, most of the time they're looking to show outsiders exactly what they can do in the money that they do have, even if they might not be financially stable. So for me, honestly, looking at this, borrowing large sums of money is different and really expensive things to give you the status or give you the feel, while you should be seeking your financial freedom and the peace of mind through building wealth, which is a positive sum game, not that zero sum game that you're putting in there. Now, of course, if you have the money to pay for it cash, that's kind of a different story and a different level of a status of wealth. But a lot of people that I see that are purchasing these very high-end cars are taking out loans, and of course, do have to qualify for loans. And unfortunately, some of them don't. Keeping up with the Joneses can be one of the absolute biggest financial mistakes that we see today. Number 2, having an emergency fund of at least $2,000. That is right, $2,000 will be the rainy day fund that you can tap in if you do have an emergency. Now, Bankrate says over 57% of Americans cannot afford an emergency with $1,000, which is kind of crazy. And of course, when you think of financial institutions through the high yield savings accounts, as well as CD rates, most Americans that can save money up in there can now get paid a pretty decent rate of return for holding money in there. Focusing on that emergency fund of at least $1,000 is the absolute priority when it comes to that financial education, and also the financial counseling piece, which I love to do. Have to make sure that you're saving some money. And again, this is something that you have to focus on, really the first step. If you look at Dave Ramsey, the 7 baby steps, number 1 is getting at least that $1,000 in there. This is going to be the rainy day. This is going to be the emergency fund that we're looking at to cover those expenses. Number 3, you're able to meet your savings and your spending targets. This is where the budget comes in. This is where the saving plan comes in. This is the ability to track your expenses. And honestly, I cannot stress this enough. When it comes to building out a budget or a savings plan, it is a life-changing experience when you start sticking to it. You can see a lot of ways that you can cut expenses. You see a lot of ways and you notice things that you might not notice if you do not track this. Again, going back to that financial education and counseling piece, this is where people really, really do miss the boat. I see a lot of individuals when we sit down at our first meetings, we go over exactly what the program is going to provide, what it is, what it isn't, and also start with filling out the budget. I give them the budget to fill out either together, bringing in statements, or filling it out themselves. And at that point, I usually do not see individuals back, which is kind of sad, but unfortunately, that is where they do look. Now, of course, this is big when it comes to knowing exactly where you're utilizing money. Is it impulse purchases? Is it regular everyday purchases that are really going in hurting your budget? Where can you save money? Where can you cut expenses? Where can you identify ways to make more income while cutting back? So really doing both sides. If you can earn more income in that pot while cutting your expenses in that second part, it can really give you a third bucket that can be very, very beneficial to having. Number 4, living below your means. This is another one, not a very extraordinary, not a very glamorous life. Spending more than you make. That is very, very fundamental, very, very basic. When you make more than you spend, or you live below your means, it gives you the ability to repay debt. It gives you the ability to invest. It gives you the ability to use your money in a much smarter way. That way, when you're looking at retirement, when you're looking at larger purchases, you have the ability to have at least some money, whether it's a down payment. And of course, when you're getting into retirement, making sure you have enough money to last all of those retirement years. Looking at number 5, you keep your debt manageable. High interest credit card, we talk about this a lot, is the absolute dent in your finance. It is the one that will tank your finances, and it will tank it very, very fast. when you start looking at Experian, average credit card balances are about 8K. 8 to 10K are average, which is kind of crazy to think that the average household owns and really manages $10,000 plus in credit card debt. When you start coupling on the 20 to 25% interest, it is crazy how much money is going towards interest. And of course, every dollar that you're putting towards interest, every dollar you're putting into those credit cards means that that dollar you cannot put somewhere else. It is not the debt repayment. It is not the investing, the savings, because you're giving money back to financial institutions. As we get into number 6, you set your own standard for success. Now, this is something that I really focus on, avoiding the temptation to compare yourself. Again, keeping up with the Joneses, lifestyle creep, whatever it is really about your own finances. For my wife and I, we now have cars that are 8 years old. That's right. There's going to be a point where we're going to have to buy some new used vehicles because we do not buy new. The sticker price, the shock is there when you look at the monthly payment. We buy a car that is a year or two old, lease turn-ins, things of that nature that have very low mileage, where if you buy a car that is 2 years old that, let's say, has 12 to 15,000 miles, the value that you're gonna get out of that, and doing the loan for 60 months. This is another part where a lot of people really do miss the boat, is if you're taking a loan out for 60 months, great, that's where it is. Even if you could do a payment a little bit less, of course, that is gonna work. When you start looking at loans that are 72 months, 84 months, 96 months. I have even seen places that are doing 120 months for a loan payment. So you're leasing your car or essentially financing your car for a 10-year period, which means at a 60-month payment, you can't afford your car. So you're stretching out the term to cover the payment and make it affordable, which means you're buying too much car and you have to look at something that is a little bit more affordable. This is where the difference comes between spending, $20,000, $30,000 on a very reliable car that you're going to have 8 to 10 years, or spending the new price tag of the 60 to 80,000 for that exact same vehicle just because it has the new car smell. For me, absolutely not. I will buy used. And of course, not only buying the used vehicles, as we do put money down, or we just pay for it in its entirety, meaning we have no car payment. You know what? If a car out the door is $20,000 and I give the salesman $20,000, I'm done. That is the end of our relationship. That is the end of our transaction. There is no interest accumulated where I'm going to pay $22,000, $24,000, $25,000 on that car. That is only worth $20,000 that I bought it for. It is a life changer and a game changer when you can pay for the vehicle and pay for it in its entirety. And the final one we look at is building your net worth steadily. This is where really the financial health comes in, is knowing your wealth is going up over time. This is going to be, of course, your investments count. It is also going to be the investment in a home, the appreciation of assets that you have. But this, again, is something important to remember with a vehicle. When you look at a vehicle, it is the biggest appreciating asset that we do have, meaning the longer that you hold onto that car, the more miles you put on that car, most of the time, it is going to really depreciate. And if it is your regular everyday driver, of course, there are going to be depreciating assets like this one. You want to focus on and you want to build things that are going to give you appreciation as building in value over a number of years. Now, when we start looking at some of the biggest really thieves when it comes to this is debt. Debt is the biggest thing, credit card debt, even looking at a mortgage loan, looking at your auto loans, even though some of them are an absolute necessity, they do have a tendency to take and remove a lot of the debt and the power that you have to go ahead and build this. Now, when it comes to net worth, of course, when you're putting money in investment accounts, when you're putting it into 401ks, IRAs, HSAs, all of those are going to grow. All of those are going to build that net worth, and it is going to steadily produce as you're getting paid. And of course, you want to make sure that it's going in the right direction and ensuring that you show all 7 signs when it comes to financial health. Even though a lot of people don't feel like it, it is still there. So guys, that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching. Join me in this video as we break down Warren Buffett's simple pieces of advice that can really work for anyone. When you think of Warren Buffett, he is one of the most successful investors that we've seen in our time. And the advice that he doles out there, I always do put into application. A lot of people take the advice, they take it with a grain of salt. They really don't apply it. But if you think about it and think about the fundamentals of this, anyone can do this regardless of who you are. So let's go ahead and get in this one. The first one we look at is starting small and being patient. This, of course, can be applied to investing. It can be applied to a ton of things in your life, but specifically thinking of the investment side of it. If you're putting away $5, $10 every paycheck, if you're putting away $100 a month, starting small and being patient, of course, is going to grow that investment with the compounding interest as long as you're continuing contributions over an extended amount of time. So if you're 18 years old, 20, 25, when you start making 401k contributions, when you start investing, that is really starting the snowball rolling, regardless of how much you have at that point. Once you start that moving, it can move faster and faster as it's growing through the years, as the contributions continue to go, as you're making more of a dent towards that retirement goal that you have, it is going to make a big difference. Now, the next one we look at is investing in index funds. If you caught my video yesterday, the VOO is the index fund, tracks the S&P 500. When you think about this, in my view, for most people, the best thing to do is own the S&P 500. That is from Warren Buffett. He said everyone should own the S&P 500 index. It is really the set it and forget it, putting money in there on a consistent basis, even looking at our first step of making it really simplified, doing it on a constant basis, and of course, giving it time to grow is going to make a big difference. Now, the third one we look at, and this one for me is a little bit more questionable, looking at bonds. He puts 10% or more of the entire investment portfolio into short-term government bonds. Right now, the bonds are paying a lot of money, so it is beneficial. And I know he put billions of dollars into bonds right now. Personally, long-term, I'm rolling over government bonds. It can make a big difference for stability if you have a lot of money to put in there. But overall, bonds are something that I wouldn't put in. Even looking at BND and a couple other ETFs that kind of group bonds together. Bonds, I wouldn't. And again, we have to take the advice as we get it. Treasury bonds and bonds in general, I wouldn't put in the portfolio. We do not see the growth that we're looking for in a portfolio. Next one we look at is understanding your investment. Risk comes from not knowing. This is one of my absolute biggest pet peeves when it comes to investing, when it comes to finance, when it comes to financial counseling. Never invest in something you don't understand. If it is ETFs, if it's stocks, if it's bonds, if it's cryptocurrency, if it's REITs, if it's real estate, you have to know exactly what you're getting into, what the risks are, and understanding exactly how that product works. If you do not know, and I always tell these individuals, especially around that cryptocurrency, if you do not know the ins and outs of cryptocurrency, if you don't understand it, do not invest in it. Don't follow the crowd. Don't follow the herd. Do not invest it in if you do not understand it. And of course, when he talks about understanding your investment, you don't need to know it so well that you can recite it, verbatim, everything. But you have to know exactly what the value is, what it does. When we talk about blockchain technology, when you talk about a lot of things that are around that crypto space, do you know exactly what it is? And do you know it well enough that you could explain it to another individual? Definitely take that again with a grain of salt. And then we think, don't follow the crowd. This one is really, really important. This is when you think of following the crowd and when you think of the subconscious investing, this is where people get it wrong. In my opinion, when we're looking in here, it is not about the temperament and really the temperament that you have in investing, not about the intellect. When you're looking to weather the storm, and we have said this before, when you think of shopping, so let's say you're retail shopping, they have a really good deal at a store. You're going in there, you're buying more. It's 30% off, 40% off, 50% off the price. You're going to be buying a lot more than you normally are because it is at a discount. Now, when it comes to ETFs, when it comes to investing, when it comes to stocks, people psychologically and emotionally see the exact opposite. When I see a market in 2022 that's down roughly 20 to 25%, that is a massive buying opportunity because everything that I'm getting in the market is at a 25% discount. And of course, they say buy when there's blood in the streets. When the market is red is your best time to invest and the best time to buy. Now, unfortunately, what we normally see is when stocks are going up, look at NVIDIA, people just start piling on. They are following the crowd. They are really dumping a ton of money into a company like NVIDIA. We know they're doing incredibly well, but now the price to earnings ratio has literally just went through the roof. Valuation has went through the roof because nobody wants to miss out on the growth we're seeing. Not saying it can't happen to some companies, but there's a lot of companies where people follow the crowd and they get completely burned. And of course, when you think about that negative market, when you think about it on sale, keeping cash on hand. When your bills come due, only cash is legal tender. Don't leave home without it. That is a huge piece of advice for a majority of us. When bills come due, only cash is legal tender. If you have money tied up everywhere, if you're literally not saving anything at all, you're not going to have the ability to cash flow. You're not going to have the ability to pay your bills back on a timely manner, which of course can affect your credit and everything else in your life if you don't have the ability to pay that off. And when we think about paying bills and when we think about that, paying off credit cards, people should avoid using credit cards, should avoid using credit cards because it is at a piggy bank to be rated. That is how people see credit cards. And it's kind of crazy. Let me read that one more time. People should avoid using credit cards as a piggy bank to be rated. This is where we're sitting almost $1.2 trillion in credit card debt. They are people, and honestly, a lot of people are supplementing their income in credit card debt because they're not budgeting, they're not spending plan, they're not really thinking of future them and getting it under control. They are living outside of their means to supplement their income. Again, that is where the credit cards are coming in. When you think about credit cards, when you think about in conjunction to debit cards to paying cash, people that spend and utilize credit cards on a regular basis really spend about 20 to 25% more than debit card users. And the reason is the justification of rewards programs, which again, that's a whole nother part I don't want to get into in this video, but it is kind of crazy. Now, when we think of Warren Buffett, we think of value, not the price. Price is what you pay. The value is what you get. That is really, really pivotal. Price is what you pay. Value is what you get. This can be applied to everything when it comes to frugal living, when it comes to being able to pick companies, pick stocks, ETFs. The price is what you pay. The value is what you get. What is going to be beneficial? What is going to give you assets? What is going to grow your net worth? What is going to build your portfolio? It is huge. I'm really looking at that again wholeheartedly. Price is what you pay. Value is what you get. And we know he is a huge, huge value investor. Now, when we look at the next one, buy quality at lower prices. Whether we're talking about stocks or socks, buying a little bit more of the quantity merchandise when it is marked down. So again, thinking of this in the education aspect of it, when the stock market's on sale, when we're seeing a dip, when we're seeing a decline, this is the time when people should be buying more. But unfortunately, like I said, this is normally when people start running for the hills. We're not going to see a lot of influx of cash to the market. Everyone is liquidating, everybody is selling when they should be buying and when they should be buying on a bigger level. Now, when we think about acting on opportunities, opportunities come infrequently. When it rains gold, put out a bucket, not a thimble. Again, the words of advice from Warren Buffett, I absolutely love it. When it rains gold, put out a bucket, not a thimble. That again can be really true. When you see an opportunity, a lot of people are very afraid to go for it. There's not going to be perfect conditions. You're not going to be timing the market. It is near impossible to go ahead and time the market. But when we look right now and thinking again, kind of in the stock market, artificial intelligence has really started to take off. Next 3 to 5 years, probably even 10 years, there is going to be a lot of growth in technology. There's going to be a lot of growth in companies' utilization, not only in the development of the AI space and technology itself, but also thinking of the utilization in really big picture using AI for everything. We're starting to see it in education. We're seeing it in the workspaces. So investing in companies like this, when opportunities come like this with artificial intelligence, I feel like this is one that we definitely cannot miss. And of course, never lose money. First rule of investing, don't lose money. Second rule of investing, never forget that first rule. That is right. That is why the rules are out there. That is why he follows them. And of course, looking at Berkshire Hathaway, they have done incredibly well since their inception. Even when you look at the companies, it's not too flashy. It's not too crazy of a portfolio that he's running, but he holds a lot of the exact same things and just more in bulk. When you think of Apple, when you think of Bank of America, when you look at Coca-Cola, he doesn't have a crazy amount of money in a ton of different things. It is more kind of concentrated when you look at the portfolio of Berkshire Hathaway. Even looking at the AI bets that he makes, a big chunk is in Apple. He sees value in the company. That is the reason why, again, I know he moves around money and the portfolio might change a little bit, but overall you can see that there is value with what they're doing it. And of course, with value comes a margin of safety. When you think about safety, this of course gets back to our emergency fund, making sure that you have money on the sideline, making sure you have money just in case. You have to have that emergency fund before you get into really paying off and eliminating all of that debt, getting rid of the credit cards, saving and investing a lot of money. The more money that you're putting towards interest will be detrimental to the portfolio, but having that emergency fund will not put your entire reliance onto credit cards, onto borrowing money. You want to make sure that the savings account you do have fully funded before we get into this investment journey. And of course, the final one in here, focus on the game, not just the score. Games are won by players who focus on the playing field, not the ones who are watching the scoreboards. That's right, you have to put your head in the game. You have to understand exactly what you're investing into, how you're going to do it, what is the game plan. This is the reason when it comes to really setting financial goals using SMART goals, this is where the game is played. When you think, okay, well, I want to invest $100 a month and I'm going to do that, I'm going to put it into the S&P 500. We're going to go with the Vanguard S&P 500, the VOO. That is my game plan. I am going to stick to that game plan. If the market goes up, great, we're buying a little bit less. If the market goes down, perfect, we're buying a little bit more. It is about sticking to that game plan regardless of what the scoreboard says. If you see the value of your stock or your holdings go down, a lot of people will liquidate it, not knowing that, of course, it is going to rebound. And we have years like this year where the S&P 500 is up about 17 to 19%, which is incredible. If you would have pulled out your money years ago, you could have missed on the really, really big gains that we see. So of course, when it comes to investing, it is simplified, and keeping it simple is the way that we're looking to do this. When we look at the 3-fund ETF portfolio, which I have a video on that, we are keeping the investment. And it's funny because I have actually got a couple comments about that video saying your portfolio is boring. Your portfolio is very simple. Perfect. That's exactly what I want to go into. When I put money into my portfolio, the three ETF portfolio, that's all I do. I put money in there every single 2 weeks. It has been growing kind of crazy over the last 3 years. So we are just coming up on the 3-year anniversary for the individual brokerage account through M1 Finance. I have some links down below, but looking at that portfolio itself, we are up about 80% as of today, which is incredible to think when it comes to a very basic and simple portfolio. It is up about 80% in 3 years, which means we could look, if it continues this year, we could double and have doubled our portfolio within a 3-year span, which is, again, kind of incredible to think that we've seen that growth. All right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think, and as always, thank you guys for watching. When it comes to paying off debt, it can be one of the most stressful situations you ever have. Sleepless nights, fights with your spouse or your significant other. Paying off debt can also give you the ability to have financial freedom, which is what we're going to be looking at today. 11 mistakes that are made when paying off debt. Now, a lot of people that I see make some of these mistakes, and unfortunately, paying off debt doesn't work out the way that they want to because they haven't planned to really pay it off in a reasonable manner, which is the first one we look at. When you think of a debt strategy, first thing you have to do is know exactly how much you have. What is the total debt? For a lot of people, this might be a very, very rude awakening or a very scary number. When you start tallying up all of the debt that you have in its entirety, we're talking mortgages, cars, personal loans, anything, credit cards, that is debt related. Student loans are going to be included to make sure you know exactly how much debt you're looking at and where you are. Now, again, you have to take this really with strides, because why this might be a mistake. A lot of people will cut back on spending. A lot of people will save money or look for extra money to pay all the debt back at once. There is a very, very systematic approach that you can use for debt repayment that you actually feel the effect of making progression instead of just putting, an extra $50 here, 20 bucks on a card, extra $100 to your student loans. If you're looking to really manage and tackle the debt, it is not so much about the balances as it is the monthly payment, because of course you only make so much money every time you get paid. X amount of it goes to debt. Whatever you got left over, hopefully it's enough to survive, and tackling that high interest debt first will make the biggest difference, and it will make the biggest bang for your buck. Now, does it make sense to pay it down all at once? It could in very extenuating circumstances. Now, what we talk about here is looking at a large bonus, a large tax refund, a windfall. Let's say you hit the lotto, something that is going to give you the ability to tackle the amount of debt. And of course, this is going to be very specific depending on how much debt you have and where you're at. If you're talking $3,000 to $5,000, might not be super hard to pay off. But when you're looking at some debt that I've seen range from $200 to $500,000 in debt, which of course, including a mortgage, which usually we exclude at that point. But when you start looking at auto loans, student loans, personal debt, credit cards, we start adding it all up. I've seen people that are north of $500,000 when they're sitting in debt, even without including the house, which again is kind of crazy. Now, a lot of people also take out payday loans. This, of course, when it comes to debt, this will crush you. When you look at payday loans, they're predatory lending, honestly. When you start looking at the annual percentage rate and you put it into, let's say, a 7-day period, you not only have finance fees, but you also have a percentage that you have to pay back. And of course, you're essentially stealing the next paycheck to get the paycheck now. They are probably one of the biggest, if not the biggest detrimental part when it comes to debt and when it comes to debt management is getting out those payday loans. Now, of course, this can be, again, devastating. And big one that I see, and this is probably one of the largest ones, is using your home equity. Now, a lot of people, consolidation, looking at a home equity might make sense for a lot of people, but the big thing with that is when you're using your house as kind of an ability or a giant credit card, if you will, using the equity in your home to consolidate debt might make sense, but are you changing the spending habits? Have you fundamentally sat down and seen exactly how this debt was accumulated? What is it going to mean when you make the home equity? Now, what I see in the financial industry is you do a home equity loan, we consolidate all of your debt, credit cards, your cars, everything is put together in this home equity. You also have to remember, home equity is putting your house as collateral. If for any reason, including job loss, you don't have the ability to repay the home equity, guess what? You're losing the house. That's right, the biggest asset that you have. You are going to be losing that in its entirety, which can be super detrimental. But like I was saying, when it comes to debt and putting it into a home equity, it's a great product if leveraged properly, because what I find is a lot of people will do a home equity. 3 to 5 years down the road, we do another home equity at a higher amount because they've accumulated a lot of new debt. 3 to 5 years down the road, same thing, rinse and repeat. The cycle continues every single time when it comes to debt because, again, the spending habits have not changed at all when it comes to debt repayment. Now, we also see a lot of people that liquidate stuff. So when you think of ways to make big mistakes paying off debt, this is heading to the pawn shop. This is liquidating a lot of things, a lot of assets. And depending on what you can get for it, it might bring you ahead a little bit, but trying to catch up on debt again with using something like a payday advance loan, doing something like a pawn shop, selling some things, whether it's marketplace, whether it's eBay, whatever it is, you are still not getting to the point of fundamentally adjusting that spending plan to manage the debt in its entirety. This can backfire because it's going to give you short-term money, but for the long term, it is not there. When you start pawning and really getting rid of some of your assets or some of the things that you love that you don't want to part with because you don't have any choice because of the debt you accumulated, there are better ways to do this. Now, we look at credit card advances. This is another one. When it comes to credit card debt, it is my biggest pet peeve that I have, period. When I look at almost $1.2 trillion in credit card debt, then you add on the percentage of roughly 25% that they're charging on that debt. It is insane the amount that Americans are paying on credit card debt on a regular basis. And I do see a lot of people that do cash advances. Now, cash advances, of course, are really tempting. Cards do have cash advance fees. On top of that, you pay the interest on those cash advance fees. And a lot of times with the interest that is paid, it's at a much higher rate. So it's kind of the trifecta of you over borrowing or overspending on that credit card. Now, in addition to this, I have seen a lot of people that are kind of, robbing Peter to pay Paul. What they've done is they're using their credit cards, they're doing cash advances on there to make mortgage payments, to make student loan payments, to make auto loan payments. They are utilizing the credit that they have with on their card to pay the regular loans, which again, they should be budgeting for properly, but they've gotten to the point where unfortunately they can't. This includes, again, not even though getting those much, much higher interest rates, which if you look at your card and it's 25%, I have seen ones with cash advances that are 32, 35, even 36%, making it very, very expensive to do the cash advance. And of course, when it comes to debt, looking and filing for bankruptcy. Bankruptcies are on the rise. We've seen delinquencies on credit cards, delinquencies on auto loans, and a lot more people are filing for bankruptcy. And you have to know exactly what this means and how it means when it comes to bankruptcy. Because for a lot of people, one, do you qualify if you're going that route? Do you make too much money? Do you have a lot of student loans? Student loans are not going to be wiped out with bankruptcy. That was changed years ago, which means your unsecured debt you could wipe out completely. But with that, you are also wiping out your credit score. You're wiping out your ability to lend for a multitude of years, usually 7 to 10 years when it comes to bankruptcy. Could be very detrimental. So if you have any big life plans, and of course, we get back to the fundamentals of what got you to bankruptcy in the first place. Where is the budgeting? Where is the spending plan? How, and I have personally helped a lot of people stay out of bankruptcy, coming up with plans. So why could it be a mistake? This, of course, can be super complex. It can also be very expensive to do bankruptcy. It can take 6 months or more to complete the bankruptcy, again, depending on the complexity. And of course, credit counseling, compiling all of your credit reports, knowing exactly how much debt you have. This could be very difficult if you're looking to get a house in the near future. If you have bankruptcy, unfortunately, that is a no-go. For most financial industries, if you've declared bankruptcy within the last 2 to 3 years, they will do zero lending for you, meaning it is completely out the door. Now, when it comes to student loans, when it comes to mortgages, when it comes to auto loans, we talked about paying it with credit cards, and that is what I am seeing a lot, guys. We are seeing, again, just borrowing money from one place to pay another one, or a lot of people that are doing unsecured loans for, $5, $7, $10,000. And what they're doing is they're keeping everything else afloat. They're using the money to pay the mortgages and the auto loans because, again, they're not budgeting properly. These are individuals that are working full time. These are individuals that are earning 100,000 plus every single year, but they are still borrowing money to sustain the lifestyle they have because, of course, looking at some of these, I have seen house payments $2,500, $3,500, $4,500. If you're making a $4,000 mortgage payment every single month, it is crazy. And honestly, thinking about, mortgages being 20, 25% of your salary, that puts you in a whole nother level when it comes to being able to make that payment and make that payment very comfortably. For a majority of people that buy into that range, unfortunately, they cannot afford. They are way overspending, really overextending themselves when it comes to the price of the house, meaning that they are very, very hard when it comes to spending and really saving, budgeting, putting money into retirement accounts, 401ks. It really is kind of crazy when you look at that. Now, of course, when we think of people that can help with debt, you got to rely on your credit union, some banks, some financial counselors. A lot of people, including myself, I do financial counseling and I do it for free. There is no cost for financial counseling. It is something that we provide at the financial institution that I work at. It is completely free. Now, a lot of people go to different companies. There are companies that will help you manage your bills, that will help you manage your debt, but it comes with a very, very hefty fee. There's actually one that is going to remain unnamed. That takes 10%. You pay them, they work with your creditors, they take 10% of what you're giving them. So again, when you think about skimming off the top, they are doing exactly that. You have to be very cautious about it because a lot of people will recruit friends, family, other people to do the same for debt consolidation. And this goes back to a lot of places that are saying, we'll fix your credit score in 2 months. We'll fix your credit score in 2 weeks. Guys, it takes time to repair credit. There isn't a way that I know, short of having really wrong things on your credit report, then going in there. And of course, getting back to the fundamentals like I talked about earlier, continuing to make charges and continuing to live on credit and live on credit cards. When you start focusing and wanting to pay down the debt, wanting to do the debt-free journey, wanting to really better yourself, you have to spend less, and you have to do this through budgeting, through your savings plan, through anything you can do to cut out the expenses. For some people, it seems like it is an impossible task, but honestly, when you take a very hard look at your budget, looking for anything you can cut, and even at that point, it's not going to be the Dave Ramsey beans and rice. It's going to be to the point where you want to cut expenses, and you can cut expenses, and you might have to do it temporarily, a week, a couple months. Get everything in line, get all of your finances in line, because when you start looking bottom line, if you're running your budget into the red every single month, that is going to catch up with you very, very fast. And there's going to be a point where you can no longer pay the bills that you have because you've been running into the red for so long. Now, of course, a lot of people, when they start looking at the red, when they start getting to this point, they stop contributions into emergency funds. They cut the retirement going down to zero, no company matches, no anything. That is kind of again, a really, really big drawback when you're trying to pay off debt, trying to make essentially the most money you can. And again, this goes back to Dave Ramsey's baby steps, where when you look at the first one, saving $1,000 and then pay off the debt like it's really wildfire, putting every single dollar you have over to that baby emergency fund, that first 1,000 right into debt can make a big difference. But again, I personally would not stop the contributions when it comes to the 401k, at least bare minimum that company match, and then focusing on, because what happens if you're not putting money into the 401k plan, if you're not looking at that company match, you're really focusing on paying off this debt. It could be 3 years, 5 years, 7 years, 10 years. You might never get to the point of putting money back into that 401k because for whatever reason, you can never conquer the debt. You can never get to the point where you're actually net positive, being able to start those contributions again when it comes to paying off debt. So guys, that is going to do it for today's video. There are a lot of mistakes that people make when they're paying off debt. But if you have any questions, if you need any help at all, definitely let me know in the comments. Subscribe to the channel if you like the content that we're putting out, and I'll catch you in the next video. The time has come. That is the resounding words of Jerome Powell, the Federal Reserve Chair, which means lower interest rates are going to be on the horizon. As soon as September, we could see a 0.25%, if not a 0.5% reduction in rate, which means how is this going to affect the AI sector? And what is it going to look like for the three biggest companies that we're going to be focusing on today? Now, if we look back at 2022, it was really the fastest increase we've ever seen. Of course, making things a lot more expensive, not only more expensive in the perspective of buying new things, but also looking at larger businesses and investment, their structure, the cost of goods themselves have went up dramatically, which of course does affect the AI sector, and making things more affordable by lowering those interest rates are going to make a big difference. So looking at some of these large players like NVIDIA has been the flag bearer and really the flagship when it comes to generative AI, artificial intelligence. When it moves, the rest of it follows. Now we know NVIDIA is going to be reporting their earnings pretty soon, which means, and people are saying it's going to be a 10 to 12% beat over the earnings that they have. Now, of course, when you think of NVIDIA and the macro development, the Fed announcement, just a big change. So when you think of NVIDIA and the price jumped on August 23rd, when they had the speech, when it came out saying the time has come, because we know exactly what this means, but NVIDIA gained 4.6% just based on what the Federal Reserve said. Now, of course, the direct impact lowers NVIDIA's business and is likely to negligible as the company is very, very high profitability, but overall they are carrying $8.5 billion in debt. When you start looking at debt of that magnitude, if you can lower the amount you're paying on the debt, it can make a huge impact to the bottom line of these companies when you think of billions of dollars of debt. Which again, looking at NVIDIA, it is a company that of course would benefit from the lower interest rates. It would encourage other companies, more spending, more investing, more AI, favorable really for the chip leader. Billions of dollars already flowing into the new technology, and they're expecting this company to be number one, $3 to $5 trillion within the next 4 to 5 years, which is kind of crazy to think that a company is going to be that much. Now, of course, this makes it generative AI expensive, but of course, startups can borrow more money. Startups can do it at a much lower rate. So lowering these rates are going to make a big difference when you're looking at some of the venture capitalists and people looking to invest in a generative AI. NVIDIA is definitely one that is going to support and has been the backbone. Second one we look at is the advanced Microsoft devices or micro devices, which of course is AMD. Very similar to NVIDIA, they are the chip producer. They are one that is in the generative AI race, recently launching the MI300 data center GPU, and their revenue is up more than 100% in the second quarter. That's huge. As when you think of the return, it's kind of crazy to think revenue up more than 100% in the second quarter. Now, of course, as a chip stock, and this is where the companies really do kind of run that common thread. When you look at the chip stock and when you think of what they're doing right now, AMD is a big performer when it comes to the chip maker, when it comes to the GPUs, or excuse me, the CPUs for this company. It just made $4.9 billion cash and stock acquisition of ZT Systems, a provider of AI infrastructure. They're doing their best to keep up with NVIDIA. And of course, on top of this, they are the processing data centers as well, using all of the cash to purchase a huge Silo AI, which of course is a massive investment. Falling interest rates will make everything easier and cheaper for AMD to borrow, make more acquisitions, buying out some of these companies, and of course to compete with NVIDIA itself is going to be a big player. Another one huge in the AI space, which is the opposite of what we see with AMD and NVIDIA, which are the chip makers, is Microsoft. Microsoft is another one that will benefit from lower interest rates, cheaper borrowing costs, looser monetary policy, encourages more spending from consumers and of course from customers, meaning that they are going to use more products and services when it comes at a cheaper price. Now, when we look at the peers and when we look at the evaluation of Microsoft in comparison to the other ones, lower interest rates will, of course, make the bonds not as worthy. It makes the stocks go up a little bit. And investing in blue chips, this is where the money is going to go. And for a lot of people that are kind of on board or a little bit behind, you have to think about this big picture. You have to think about the economy in its entirety. Right now, a lot of individuals have money into bonds. A lot of money a lot of money went into T-bills, these high yield savings accounts. We've seen it with a lot of CD rates. As the Federal Reserve continues to lower rates and as they continue to kind of move that bar down, all of the CD rates, the high yield savings, the bond rates, everything is going to slowly dissipate over the next probably 6 to 12 months. Could even look at 18 months. A lot of this is going to dissipate, meaning all of the funds that were put into these CDs, these high yield savings accounts, everything else is going to have a place to move. That is the money that is going to be moving back into the stock market, going to be moving back into the crypto market. There is going to be a massive outflux within, again, the next 6 to 12 months when it comes to all of this money in financial institutions, because of course, financial institutions will no longer need the money that they generated and that they really have, or really paying for this money on the CD front, because rates will be lower to borrow money themselves, making it a lot easier. And this will actually speed up the economy. Now, the fear within here is, what if the economy really starts booming again and we start seeing, the borrowing start coming down, people start buying a lot more, because this is kind of by design. They're going to have to really take this with kid gloves, do it really at a slow pace. And that is why the reason I feel the rest of the year we might see a 0.25%, which of course might come in September. And that might be the only adjustment we see in the year. Now, also remember and keep in note that it is an election year. So that is a big player when it comes to the stock market. Both the Republicans and the Democrats makes a difference. And honestly, big picture doesn't make a big difference when it comes to the policies, but that is where we could see exactly what's going to come out with the policies, who's going to win, and what's going to happen with that. Now, when we start again looking at Microsoft, they are partnered with OpenAI. Now, if you're unfamiliar with OpenAI, it is a private company, which of course lower interest rates mean they can borrow more money as Microsoft. Microsoft can pump more money into OpenAI in the development of technology, making sure that they are really having the cash flow and freeing up some of the cash flow and some of the money that they've borrowed to develop the artificial intelligence, which of course in turns runs on the chipsets from AMD and also the chipsets from NVIDIA. So we know it's going to be huge. So a lot of people are saying, is NVIDIA worth investing into? My thoughts right now, the answer is yes. Looking big picture, what artificial intelligence is doing, even looking at, schools, public schools where my kids go, they're incorporating artificial intelligence even on a very educational level, that they have the ability to use artificial intelligence to educate a younger generation, which again is kind of crazy to think that there is going to be that much of a difference with artificial intelligence. But if you're anything like me, being in the YouTube space, artificial intelligence is here. If you look at, utilizing vidIQ, using Canva, using anything even in content creating, anything in writing, artificial intelligence is here. It is incorporated into everything that we do on a daily basis. When you start looking at Copilot, when you look at OpenAI, ChatGPT, most people are using artificial intelligence in some way, and they've incorporated it into a ton of other ways. And a lot of people, again, kind of thinking big picture, Is artificial intelligence going to slow down? Are we going to see people start pulling it out of places? Are we going to see places where it is no longer utilized? Not at all. They have an NVIDIA target rate now. I know the current price is around $128, but they're looking at a target price of probably 160 to 180, which means that NVIDIA has a lot of runway to grow. And especially if they come out and their earnings beat on that 10, 12, 14%, which is kind of anticipated, it's going to set the tone for the entire market. And you could see it blow up much higher, much faster than we've seen in the past as artificial intelligence continues to grow. All right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching. Congratulations, you finally got that $10,000 saved up. It is invested. But how are we going to turn this into $1 million? That's exactly what we're going to be looking at today. 7 steps to grow your $10,000 investment into the $1 million investment. Now, of course, this mathematically has to do with investing, and investing is a virtue. It takes money to grow the money you have. When you're trying to grow wealth, especially looking at $1 million or more, you can't take advantage of putting the money away and really forgetting about it. And it is going to be imperative that you do just that, because there are some really good money moves that you can make. So investing $10,000, but nothing else at 10% for 25 years. So when we think about this, you're talking 2.5 decades, 25 years investing that $10,000. First of all, most people are not going to do this. And starting off with a pretty good nest egg, putting in something like the S&P 500, which yields about a 10% return, even if you put it and leave it in there for 10 years, you'll fall short. That's right. You'll only be at $108,000 in 20 years, which means we're going to have to set this up. We're going to have to really put it in there for a different time frame. $10,000, 10% return, 25 years is not going to cut it. Now, if we take that same $10,000 and we invest it at a 20% return for 25 years, now we're a lot closer. But guess what? It is near impossible to get that 20% return. Even if we look at some of the most famous investors in the world, like Warren Buffett, since the inception of Berkshire Hathaway, has yielded about 19.8%, still under the 20% that we're looking for, that we would need to turn that $10,000 into that $1 million within that 25-year period. Now, of course, if you think about it, theoretically, if you could get that 20% return, this would turn it into $953K. So just being a little bit short. But let's get into how we're going to turn this into, again, that $1 million. So thinking of our same $10,000, adding in another $1,000 on a monthly basis, 10%, 25 years. So again, using the same math equation. So can you reasonably reach that $1 million mark? Yes, with the initial investment of $1,000, $10,000, $1,000 a month, 10% return, 25 years, that puts you at $1.2 million with compounding interest. So we are there. So looking at $10,000 plus $1,000 a month, which we know $12,000 a year, 10% return. So if you're putting this into the S&P 500, you would get there and you would hit this $1 million goal within that 25 years. But how else can we do it? Looking at that $10,000 plus $1,500. So now instead of just investing that $1,000 a month, we're stepping it up to $1,500, same 10% return, but now shortening the time frame. So this, we're putting that time frame to 20 years. So with a $500 initial or additional investment on a monthly basis, we are cutting 5 years off the back end of this, meaning the compounding effect is going to work really well. And of course, coming up and budgeting everyday expenses with you, your partner, especially if you have dual income, chances are you can come up with a little bit more than save kind of on a monthly basis. Now that's right. This would put you a $10,000 initial investment, 10% return, which is feasible. 20 years would put you at $1.1 million in the retirement account in just 20 years. So think about that for a minute. When you start looking big picture, majority of people really start investing at the age of 35 is when they seem and really get invested and get serious about investing. 35 to 40 is really the time frame, including myself, where I got really serious about investing, putting a lot more money in there, and of course, starting to really get that snowball effect. So if I had $10,000 to put in at age 35, putting in $1,500 a month at that 10% return for 20 years would give me the 1.1 million. And in 20 years, starting at 35, I would only be 55 with $1.1 million in there. Kind of impressive to think. But how and what if you had a shorter time frame? What would it look like if you only had 15 years? Again, starting with that initial $10,000, this would require you to put $2,550 at that 10% return for 15 years. And this, of course, would get you just a squeak over $1 million. So pretty much $1 million. And this, of course, is putting it into just the S&P 500, which is an index fund, which is what I personally invest in, and I have for an incredible amount of time for the VOO. So again, you're having that same initial $10,000, adding that $2,550 per month with the 10% return, which is the average of the S&P 15 years instead of the 20, instead of that 25, and you can kind of see where this is going. There is a multitude of ways that you can reach this $1 million mark, because then when we start thinking, let's say not even getting that 10% return, so the investments you're investing in not really as predominant, so taking that same $10,000, investing $1,100 a month, 8% for 25 years. So we're no longer getting that 10%, but we're getting that 8% for 25 years. This is still going to get you to that $1 million mark. And of course, this is with the additional contributions. If you're looking at a shorter runway, shorter time frame, looking at that 20 years at that 8%, now you're up to $1,800 a month that you have to put into that account in addition to starting with that 10,000. But again, when you think about that, when you think about the return, 2% return makes a very, very big difference when you're starting to compound that annual return over an extended amount of time. And you can see exactly, again, where we're going with this. When you think of your 401k, when you think of your investment accounts, when you think of your retirement accounts, you have to know exactly what they're returning. You have to pay attention to this. For a majority of people that are in target date funds, they are underperforming or really very poorly, honestly, to put it, underperforming the S&P 500. So depending on what the portfolio looks like, your money might be a lot better invested into something like the S&P, the index funds, versus going into a 401k. And also pay attention to what percentage they're charging you when it comes to investing itself. Now we get into the last one, guys, which is investing $10,000. You have to add $3,000 a month for that 8% return. And with a guideline of 15 years or spending it over 15 years, this would still put you at that $1 million mark. But of course, this is depending. So thinking of the first three scenarios, we did at a 10% return. The second scenarios, we did at an 8% return. You're talking hundreds of dollars on a monthly basis for an extended amount of time that you have to invest in here to make sure that you're hitting that return. So let's say, for instance, you only had 10 years. You're 55 now. You're really hard. You want to go at this with really fire. You want to go in and you want to do a 10-year return, $10,000 again, your initial investment, $5,100 a month at that 10% return for 10 years would still cross and break that threshold of $1 million. So depending exactly how much and how aggressive you want to get at this point in life, you can get $1 million, and there are a multitude of ways to get there. So bottom line, guys, when you're trying to hit that $1 million milestone, really choosing your own adventure, putting $10,000 away for that 25 years, 20 years, you're never going to make it. It is about the contributions. Now, of course, it's not yourself, and you have to think about this big picture, where if you're putting an extra $1,000 away into, let's say, your retirement account every month, so you're looking at $500 a paycheck, but you also have to take in a factor of the employee match if they're doing it. So getting to that $500 a month or $500 a paycheck, $1,000 a month might look a little bit different. And of course, if you're like me, get paid bi-weekly, you get 26 pay periods. So there are 2 months that you actually have an extra paycheck, meaning if you're trying to get to 500, it's more like probably 370, 380 if you average it out. So it is feasible to put away, that $1,000 a month. If you look at it, you add in the company match, you add in anything else. And of course, when you start extending this across an expended amount of time, when you start looking at getting raises, promotions, increasing your salary, having a side hustle, there is a multitude of ways to ensure that you do hit that $1 million mark. All right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching. What if investing could be so simplified? all you had to do was put money into one ETF, set it and forget it. With constant contributions, you could go ahead and grow this portfolio into millions of dollars. That's exactly what we're going to be looking at in today's video, the S&P 500 and why people have said you should own it in its entirety, and why could this one ETF be the way to get those millions of dollars. Now, when we think of investors like Warren Buffett, he said everyone should own the S&P 500, but what exactly is the S&P 500 and what does that mean? So when we think of the S&P 500, this is roughly the 500 leading US companies created in 1957. The S&P, or Standard & Poor's 500, was the first stock index weighted by market capitalization. That is something very important to note that we'll look at in just a minute, because depending on the size of the company, it is going to have a much heavier market weight, which means when we start getting these mega companies, these huge artificial intelligence, these tech companies, they're holding a bigger portion than some other companies. And of course, the S&P 500 makes up 80% of the total US stock market, which is huge. Putting money into this S&P 500 gives you instant diversification. Currently holding 504 on different companies, different holdings within the S&P 500 index, which means you're invested into every sector that we have out there. Now, when you think of the S&P 500, some of those big companies, we're talking about Apple, Microsoft, Amazon, Tesla, Visa, Home Depot, Coca-Cola, Walmart, McDonald's. When you start looking around your house and household goods, majority of stuff that you see is coming from those companies that are within the S&P 500. But why exactly and how do you invest in it? Let's go ahead and take a look at my favorite ETF. And as you can see here, this is one that I do personally hold in my portfolio, and I hold it in a really big weight. This is the VOO, or the Vanguard S&P 500 ETF. Now again, this is one simple ETF, and thinking big picture as we go through this, investing in this one ETF would make a really, really big difference. Now, of course, we have the fact sheet. The VOO is the ticker symbol on this, but when you start looking at the year-to-date returns, it is 19.37%. Year-to-date returns, even with the NAV right here, 19.5. So we are seeing north of a 19% return. When you start putting this in perspective to high yield savings that are offering 5%, CDs that are offering 5.5%, the S&P 500 this year particularly has been on fire. This, of course, driven by those mega cap stocks, those big Apple, the Nvidias, everything that is held in this portfolio, which we'll kind of break down, is on fire with artificial intelligence. And if you think, and this is a good way to look at it in a way that I kind of pose it, is when you start looking at something like the VOO, in the next 3, 5, even 10 years, do you think we're going to be utilizing artificial intelligence a lot more than we are today? Chances are that answer is probably yes. Do you feel that we're going to be a lot more reliant on technology, on computing software, on cloud computing, on some of the really big things that are driving some of these larger companies? The answer for me in that scenario is yes again, which is the reason why this is such a very good investment. Now, when you think of the VOO, the Vanguard S&P 500 ETF, this tracks the index that we were just talking about, that Standard & Poor's index. So this is mirroring the actual Standard & Poor's index, that S&P 500, with what they're holding in here, with the weight, with the distribution, everything else. Now, of course, when it comes to the ratios and when it comes to expenses, this is one that is very, very low. I know it is a 0.03, which means when you look at the expense ratio, most financial advisors charge about 1%, maybe 1.5%. If you put everything in here, you're paying a 0.03, which is almost nothing when it comes to the comparison. So looking at the total returns, this is where it does get really interesting. So looking at a month, 1.2, which is actually right down here. 3 months, we're already up 10%. This year, as you can see, year to date right here, 16.58. Now, of course, that is a very, very big growth factor. And all years are not up years. Even looking at 2022, it was a down year, and it was down a lot when it comes to the S&P 500. But then when you start looking at a year, we're at 22. Of course, 3 and 5 year kind of indicative of how the market has been trending. But what we want to look at is over the last 14 years since inception, which of course was 9/7/2010. So coming up on 14-year anniversary of this specific ETF, we are yielding a 14.51% return. So 14.5% over 14 years. When you start thinking about that growth factor, when you start doing contributions and adding money in here, even if you started with a larger nest egg in this, and if you kept it here for the 14 years, you would see a 14.51% return, which is incredible when you start thinking of compounding. Now, of course, the expense ratio, like I said, is a 0.03. Very, very dismal for the expense ratio, which is perfect. When the average expense ratio is 0.78, I mean, you're talking what, 20x what it is for the VOO. Kind of crazy to think how effective this really is. Then, of course, the benchmark is the S&P 500, which is, again, this is considered the beta or the 1.0. This is the deviation from where they are. It is spot on because it does track that S&P, that Standard & Poor's 500. Now, when you start looking at the price really doesn't make a big difference because you can buy this in fractional shares with M1 Finance. You can do it with Robinhood. You can do it with a lot of different places. So even here, I don't need $518 to go ahead and invest in a share. You can put 50 bucks in there. You can put 100 bucks in there. It will buy fractional shares of this, which makes a big difference for people who don't have a ton of money to start investing. But it also makes a difference. Let's say you're putting $100 away a month and you're putting it in there. You're putting your $1,200 a year. This is going to snowball. This is going to build when it comes to the portfolio. And of course, you can kind of look at it, the data, the analytics, the 52-week high where the low was. Kind of crazy to see the variance, but remember, we are not looking week to week. We are not looking month to month. We are looking, 5 years at a time. We are looking decade to decade. Even now before retirement, I have another 20 years. If we have another 20 years with the VOO that even yields, a 10 to 14%, that is going to be incredible. But when you start looking, since we started the Standard & Poor, which I believe was in 57, it has yielded about 11%. Even there, the growth factor just for that S&P 500 is phenomenal at 11%. Anything north of 10%, I will absolutely take it. Now, when we start looking at the portfolio, like we said earlier, 504 different stocks make this up. And you'll notice the investment style, which of course is by Vanguard. It is a large cap. It is a blend. So we know Warren Buffett looks for a lot of value. We know a lot of people look for growth with like the VUG or the QQQM, a lot of those big tech stocks. This puts it in the middle. That is the reason why I love this, is the instant diversification. Again, it's not really overvalued because you have a lot of companies that are doing incredibly well. And of course, if you do have companies that are underperforming, that's okay because we're taking the net average of those 504 different companies. There might be some losers. There's a lot of winners in there. And I believe at this point, it's about $13 billion, if I remember correctly, 13.8, $14 billion to even rank in the S&P 500, the top 500 companies in the United States. So we are talking large companies of about $14 billion, which is kind of crazy. Earnings growth rate, 17.9. So doing pretty solid there. Now, of course, risk associated, do your research. Do your research on everything that you're really investing in. But this is where I do like the breakdown as well. And you'll notice the biggest chunk in here is information technology, IT 31.4%. This, of course, is by the market cap. That, again, is something that we talked about earlier, something that is very important when it comes to the market cap in here, because the information technology, the Apple, the Google, the NVIDIA, those companies are so large. They're taking up a bigger chunk. There are different ways to invest in the S&P 500. You can actually do it by the companies themselves, but you'll notice with a lot more weight in these technology companies, it gives you a lot of room for growth, but you're still getting a lot of stability when it comes to financials and energy, when it comes to even communications, consumer discretionary, staples. You're getting a lot of diversification out of here. Even though you have a lot in this information technology, you are still spread out across the entire sector that we do have there. And then, of course, when we start looking at the actual details, again, Apple, Microsoft, NVIDIA, Amazon, Facebook, we can see that all of these larger companies do have a big percentage of the fund, which is that tech portfolio, but it is kind of leveled out as well. When you look here, what, 6, 8, 18, 19. So even NVIDIA, Microsoft, Apple make up roughly a little less than 20% of the total holdings in here, which again, by market cap, they are the largest companies. You're talking what, 83, what's that, $83 trillion? No, maybe that's, math might be a little bit off on the commas in there, but these are the largest companies. And even when you look, I mean, if NVIDIA is coming in at 74, Amazon's coming at 44, they're almost double the size. I mean, they're getting there, they're getting closer, and they're going and growing a lot faster than we see. So what does it look like on the compounding aspect? Let's go ahead and take a look at that. Now, this is another tool that I use, investor.gov. This, of course, is the compounding interest calculator. So when we think of an investment, and let's say we're just putting, let's say $10,000 in there right now. So there we go. So we got our $10,000 in there. Monthly contributions, we're not going to put anything in there. We set it and forget it. We put our $10,000 in there. And length of years right now, I have 20 years until I'm 65 years old doing and getting that retirement. So we're at 14.51. Was the percentage up or down? We'll say maybe 2%. That way we put in a little bit variance if it does really well, but we're looking at the averages. And even if we put in, let's say conservative, let's say a 10% growth with a little bit of variance up and down, then when we calculate this, that gives us $67,000 right there. So on a 10K investment, again, that compounding interest, we're putting and getting 67K out of this, totally leaving it alone. That is not putting another penny in it. That is just the growth factor, the compounding factor. And of course, depending if we're above the variance or below the variance, you can see from 96 to 46, depending exactly where we are. Now, it gets interesting when you start making your monthly contributions, because let's say, for instance, we start off with that $100 that we're putting in every single month for our contribution, 67K over 20 years, suddenly goes to 136K. So we're over double where we are. Again, the compounding factor is putting it in. Now, if we start off earlier and we're putting in that 15% of our income, and again, thinking of someone who is younger, 18 years old, they're a new investor, they have absolutely nothing, but they want to start doing the contribution and they want to put, let's say, $200 a month away. This is where it kind of gets crazy. Is the earlier that you invest, the more you're going to have. And when we start looking at, let's say 40 years, for instance, because if you're starting at 18, let's say 20, even let's say 25, so the 25 to the 40 years puts you at 65. So those are your working years. At retirement, you are just putting that $200 away. Boom. When you start looking at that, initial investment was nothing. We started off, we got out of college, 25, we started investing. That gives you $1 million. Right off the bat, $200. Now, of course, when you start thinking of really over 40 years, over your entire working life, let's say instead of $200, you start off early, you start putting that $200 away, even $100, and then we take the average. So the average over those 40 years, let's say your contribution on average is about 500, which again, there's going to be later years where you're higher up in a company, you're getting a bigger salary, you're getting more of an income, you have the ability to continue. Now, when you think of really scaling, so if I start a new job and I'm putting away that 15% and I'm 18 years old, 20, 25, when you start your career, you do that 15%. Through the next 40 years, getting raises, getting promotions, getting everything else, if you stick with that 15%, it is going to be crazy with how much money you see comes out of this, because if we're looking at averages, just looking, the salary is roughly 67K. When we think of the contributions, when we think of the matches, everything else, all of a sudden your 1 million goes to 4 million, and very, very fast when you have $4 million for retirement. This is a fun tool to go ahead and really play around with and see exactly where you get and what it looks like. Because again, $800 at age 25, that is a ton of money. When you're starting off, let's say you start a new job, you're making 25, 30K a year, doing pretty well. All of a sudden, you fast forward 20 years. Now you're, instead of making that 25, 30K a year, now you're making 80 to 100K a year. Boom, monthly contributions can definitely get there. And this also doesn't include the company match, where if you're putting in, let's say 10% or your regular 15%, which is the ultimate goal. Once we get to that 15%, we can keep that 15% contribution in there and really run it for the long term, making a big, big difference. And of course, again, company matches, a couple other things. Numbers are really just an estimation, and that's exactly why it is just an estimation range on how much you're putting in there and where you're at. So for instance, right now, I'm at about 400,000 is where we're at. I am putting in, and I know it's kind of crazy, around 2,600 a month. But thinking of the numbers, and I have 20 years until I'm in 65. If I stay with exactly what I have now, we're looking at $4.5 million is where we're going to be sitting if I work in my entirety, all the way to the point of being 65. This is where we are now. Of course, This is only my 401k that we have in the VOO. It is in the large cap. But looking at this, if we stay around that 10%, this also doesn't include everything we have for the kids, doesn't include, the independent investing I'm doing, as well as what my wife has for an investment account. So it's kind of impressive to see, again, where those numbers can be and where you can really get them to with the compounding growth. So even looking here, when we look at our contributions, so contributions, they don't come in very high when it comes into the contributions. And let me see, because if I take out, I was trying to think exactly how to do this, because the initial investment with the contributions, but if we just did the contributions, I don't think it breaks it down that far because of the variance on what exactly was contributions and what was initially what we did have. I thought for some reason that it did break it down somewhere on a table, maybe. There we go. So it shows the variance again, but contributions, of course, make a big difference. Because even if you're starting with nothing out for those 20 years, contributions right here are roughly 1.7, almost $1.8 million just from the regular contributions into those investment accounts. All right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.